Hello Accounting Superstars, this is Professor Don Bush from the Accounting Superstar channel. So glad you're here. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting, so you've come to the right place. Hey, here's another picture of where I work. I've been sharing a lot of pictures with you of Regis University. It's a wonderful school in Denver, Colorado, and I've been teaching there, I think, 27 years. I've kind of lost track a little bit. But good school, very pretty school too. So today's lesson is working capital. We're going to learn how to calculate it. It's something that's really important, and a lot of people don't understand it. It's the easiest thing in the world, folks. It doesn't get any easier than this. I mean, it's super easy. Okay, if you've watched any of the other videos, maybe you saw the video on the current ratio. Well, working capital is very similar to the current ratio. With the current ratio, what you do is you take current assets divided by current liabilities and you get the current ratio. It indicates your ability to pay your bills. Now, working capital is very similar. It also indicates your ability to pay your bills. It's kind of looking at things a little differently though. All you do, here's all you do. This is as easy as it gets here. I could probably end this video right here. So what it is that working capital is current assets minus current liabilities, not dividing. So you might say, well, what's the big difference? Why do we need working capital? Well, they do, working capital and the current ratio do indicate pretty much the same thing. But one thing I do like about working capital is that rather in percentage terms or something like that, it is in dollar terms. So it's a dollar amount, which is good to know, especially if you're going to expand your business and grow your business, folks. Here's the lesson you want to take away. If you're not an accounting major and you're watching this, here's what you want to take away. If you want to expand your business and you want to grow your business, you have to have working capital. Not only do you have to have working capital, but you have to have sufficient working capital. Because if you don't, no matter how good your plans are, no matter how excited you are about growing your business, it won't work. It won't work. It's like the law of gravity. You can't go against the law of gravity, right? So you have to have working capital, and you have to have sufficient working capital. So you might ask, well, what do you mean by sufficient? You got to have enough working capital to carry you until your expansion becomes profitable on its own, all right? So you have to figure that out. I can't tell you what that is. It depends on the situation. It depends on what you're trying to do. So working capital here is the formula, ladies and gentlemen, right here. Let's bring that up. Working capital is simply current assets minus current liabilities. Easy. All right, so how to calculate working capital? All we're going to do is take current assets, subtract away current liabilities, and we're done. All right, so I've got some financial statements right down here. Here we go, splitting the screen so we can see what's going on. All right, so what we'll do is go to the balance sheet, because that is where you find current assets and current liabilities, all right? So current assets, well, current assets are things that are cash or things that you're going to turn into cash within a year. All right, so that'd be your inventory and accounts receivable. Now, if you're an accounting professor watching this, or or a real geek here, the definition for a current asset is a little bit more to it than just that. But for now, let's run with it, okay? For now, our definition between you and me is a current asset is something that we will turn into cash within a year. So it's going to be cash or things that turn into cash within a year. So what we have here is we've got cash. All right, so I'm going to highlight this in a different color just so it stands out. And accounts receivable, well, I hope you're going to collect those accounts receivable within a year. And if you're not, don't include it. Inventory, I hope you're going to sell that inventory within a year. And if you're not, don't include it. So these are things that you're going to turn into cash within a year. Now, short-term investments, it depends on what's going on with your business. With most businesses, they could turn that into cash if they wanted to. They could cash in those short-term investments and receive cash. So I'm going to include them. So all we need is the grand total here of the current liability or current assets. And sometimes on financial statements, well, very often on financial statements, they'll have the total current assets listed for you, just like that. But if they don't, it's simply things that you're going to turn into cash within a year. All right. So all we're going to do is take this 381,850 right down here for year one, and we're going to put it right up here, just like that. And we'll do the same thing for all the other years. Year two, it's going to be 650,000. Year three, it's going to be 912,000. Year four, 1,013,000. There you go. All right, so now we need the current liabilities. So current liabilities, they show up on the balance sheet in the liability section. And these are bills that are due within a year. And of course, that's not the exact definition of a current liability, but close enough. We're running with it. So things like accounts payable, that's money that you owe to your vendors, and they will want to be paid within the year. Uncle Sam, oh man, tax man, always wants to be paid within a year. Short-term notes payable, and we're going to assume here that this is due within the year. So total current liabilities, here we are. So all we're going to do is take the 206,750 and put it right up there. The 412, put it right up there. The 226, there we go. And finally, last and not least, 420 right up there. So you see what we're doing. Okay, so rather than dividing like we did with the current ratio, we're going to just simply subtract. So it's going to be dollars. So the working capital for year one is 175,100, and subtract again, 238,000, 686,000, 593,000. So there's our working capital, folks. And for Sunset Sailboat Company, it looks like the working capital is going up and up and up, you know, up more or less. It's kind of an upward trend. I mean, it's not exactly an upward trend. You know, most things in finance don't move in a linear form. They usually, there's some ups and downs and ups and downs, and you just got to look at the trend. And it looks like, to me, the trend is pretty good, working capital. So what does this mean? It means that the Sunset Sailboat Company can take advantage of opportunities when they arise. You know, I'll give you an example. Here's an example, a real true example. I was out at a garage sale. This was many years ago, probably 30 years ago now, but I still remember this. And there was this beautiful, beautiful Craftsman table saw. And you've probably seen them. You know, I'll probably find a picture, flash it up here on the screen here for you. But I found a Craftsman table saw. Back when Craftsman made really good tools, their quality's kind of gone downhill a little bit. But anyways, and it was at a garage sale, and it was for like $100 or something like that. And it was in beautiful condition. And it was a steal of a buy, but I couldn't buy it. I didn't have enough money. I had to pay my, you know, phone bill and rent and whatever else I was paying back then, you know, had to buy food, that kind of thing. And so I couldn't buy the table saw, even though it was a fantastic opportunity. And that's how working capital is that businesses have opportunities also. And if they don't have enough working capital, they can't take advantage of those opportunities. And if they do try to, they put themselves at great risk. So this working capital is pretty important. So Sunset Sailboat Company, the working capital is increasing. Now the Sunset Sailboat Company has a competitor called Captain Jack. Captain Jack Sailboats. All right, so let's see what's going on with his working capital. And the reason why I'm bringing up Captain Jack is because it's a really good idea to compare against close competitors. They have to be very close competitors. But even still, close competitors are totally different businesses. And it's, you got to be careful when you're comparing ratios and other things against other companies. Kind of get yourself in trouble. All right, so 560,000 in year one. Wow, that's seems pretty darn good, you know. That's what the Sunset Sailboat Company is ending up with, more or less. Well, in the next year, 495, so there's a drop. The next year, 320,000. Looks like a trend is developing here. And in the next year, 340,000. So they did come up in the fourth year a little bit. But it looks like things are kind of dropping. And if I was management, I'd be kind of worried about this. I'd be looking into this carefully. So this is an indicator of the ability to grow. So let's just hit on a couple of points about this. All right, so what is working capital all about? Well, it's a measurement of liquidity. Liquidity is how quickly you can change something into cash. This is a word that you really need to know if you're going to be a business major. Learn the word liquidity, especially if you're a finance major or anybody. I mean, just learn, it's easy. Liquidity means how quickly you can turn something into cash. Solvency, your ability to pay your bills. And then operational efficiency, like what are they getting done with their working capital? What are they accomplishing? What are their sales compared to working capital? So those are ratios for a future day. So number two, it's an indicator of the ability to invest and grow. If you don't have working capital, you can't invest and grow. It's not going to work. It just won't work, all right? And I've seen business, I think I've mentioned this already, where I saw businesses that tried to grow, didn't have enough working capital, and it failed. It just failed. These were good businesses too, really good businesses, but the management didn't understand you have to have adequate working capital. Number three, indicator of ability to fund current operations. So how are current operations going? Do we have enough money to keep things going here as we are? Forget about trying to grow and expand. Are we doing okay the way we are? And number four, does not indicate the quality of the current assets. Now the quality, what I mean by that, are your receivables really collectible, or are people just not paying you? What's going on here? And your inventory, is your inventory good? Is your inventory sellable? Is your inventory ruined? Is your inventory obsolete? Is your inventory something that people really don't want to buy? So number five, new projects or business expansion usually requires an investment in working capital. In fact, I can't really think of a time when it doesn't. And you need to have enough of it. And you might say, well, how much is enough? Well, that's what you need to figure out. That's why you're getting this business education, so you can figure this stuff out. All right, so here's some working capital for some common companies, just so we can see what companies have here. And you'll be shocked here with a couple of them. Walmart, negative $2 billion. So you might be thinking, oh my gosh, Walmart is suffering. Oh, they're doing horrible. Current assets minus current liabilities, negative. Oh my gosh. This means that their current liabilities are bigger than their current assets. For most businesses, this would be devastating. This would be like bankruptcy court time. But Walmart is not going to be claiming bankruptcy anytime soon. They are very healthy and making lots of money. So what's going on here? Well, Walmart is in a very unique position. They can tell other companies when they're going to pay their bills. And the other companies say, yes, sir, Walmart. Okay, whatever you say. All right. So they're in a very, very fortunate. What's going on here is that the vendors and other creditors are financing Walmart's working capital, essentially. They're financing all the inventory. And Walmart doesn't have much in receivables. Southwest Airlines, see what they have. They've got $8 billion in working capital, all right? And you might say, well, is that enough or too much? Well, it depends on the industry. Apple Computer, they've got $38 billion in working capital, all right? And again, you know, is that enough? Is that too much? You don't want to have too much, because if you have too much working capital, then you're not putting it to productive uses, because a lot of working capital, like inventory, just sits there and collects dust, and you don't want to have $38 billion collecting dust, all right? You'd have to have a pretty big mattress to stuff that $38 billion under your mattress. Coors also has a working capital of negative $2 billion. And this is pretty common in the beer industry. And I think the reason why is because in good times, people drink beer. In bad times, people drink beer. I would imagine that Coors and the beer industry is a very stable industry, so they can get away with having a negative working capital. I mean, so please don't think your business can get away with a negative working capital. I know personally speaking, in my own finances, I would not want to have a negative working capital, for speaking for me personally. And I don't think you would either. Now, let's see here. Anything else? Okay, one last thing, guys. Check out accountingsuperstars.com. I've got all my videos listed by topic, and they're easier to find that way. So go to accountingsuperstars.com. It'll be a lot easier for you. Also, hit the like and subscribe button. That way, YouTube knows you like these videos. This way, I know you like these videos, and it'll encourage me to make more of them for you. So until next time, over and out.